fundsupermart.com.
Hi Veronica, within fixed income, where do you think are the best opportunities right now for investors seeking a meaningful return?
Within fixed income, we see value in corporate bonds. When we think about fixed income markets, we can think of it in two broad categories: government bonds versus corporate bonds. Government bonds are now trading at historical low levels. Corporate bonds offer an attractive pickup over government bonds. For example, US 5-year US Treasury is yielding you 0.6% per annum. But if you're prepared to buy a corporate bond, say a Hong Kong corporate, you can get yields of 3.5% to 4% for 5-year exposure. So the yield differential is more than 3%, which is fairly attractive. And within the corporate bond space, we see value in Asian markets. An Asian corporate bond typically gives you some good pickup over a US or European corporate paper of equivalent tenor and rating.
The LionGlobal Asia Bond Fund has done pretty well in 2012, achieving more than 7% returns year to date. Can you tell us more about the fund's investment philosophy and strategy?
This fund invests in corporate bonds, so the key strategy is credit selection, that is a bottom-up process. This involves in-depth analysis of companies we invest in. We look at the management, we try to understand the business model. We like companies with credible track record, and a sustainable business model that would generate healthy cash flow so that the company can comfortably service its debt obligations. Our strategy is to look for undervalued credits that can provide some capital appreciation opportunities. We combine this bottom-up process with a top-down approach. In a top-down approach, we evaluate macroeconomic fundamentals, look at the market technicals, and look at the valuation. In addition, we enhance portfolio returns through tactical allocations in currencies.
What has been driving the performance of the LionGlobal Asia Bond Fund?
This is an unusually good year for Asian credit markets. To me, the markets are trading off technicals this year in a low interest rate environment. The LionGlobal Asian Bond Fund has delivered 9.4% return for first half 2012. On the average, Asian corporate paper would give you a coupon carry of 4.5% to 5% per annum. So the outperformance is derived mainly from capital appreciation, which is achieved through A, interest rates moving lower, and B, good demand for corporate bonds. The good demand for corporate bonds this year is evidenced by the strong inflow into emerging market debt. Year-to-date inflow is more than 10 billion, which is a very high inflow. For the rest of the year, our outlook remains positive, given that the net new supply is likely to be in a single-digit billions, so it is a low supply.
Within Asia, are there any countries or sectors the fund is positive on?
We like crossover credits, short-dated high-yield corporate papers, and Hong Kong corporates. Crossover credits are companies with split credit rating. One rating agency may rate it investment grade, another may rate it high yield. Crossover credits are trading in a sweet spot and offer you attractive pickup over a pure investment grade paper, with some potential for capital appreciation when it gets upgraded to a full-fledged investment grade paper. Selectively, we like some of the high-yield corporate papers with short maturity, 2 to 3 years remaining maturities. In the event we get summertime rerun of a bad movie in Europe, the short dated will mitigate the volatility. We like Hong Kong corporates. In first quarter 2012, Hong Kong corporates tapped the market aggressively because of tight US dollar liquidity onshore when European banks deleverage. The sector has done well. We think current pricing still offers value relative to the strong quality of the underlying credit fundamentals, and we continue to overweight that sector.
On the other hand, are there any investment ideas the fund is underweight on?
We are cautious on India. The noise regarding a potential downgrade of the Indian sovereign from investment grade to high yield is gathering momentum. In the past few weeks, S&P and Fitch have put the rating outlook to negative. The concerns on India are mainly macroeconomic. It's got a fiscal deficit, the current account is widening, there is concern on asset deterioration at the banks, inflation remains sticky at elevated levels, and in the past 6 to 12 months, the Indian rupee has depreciated 25% against the dollar. Indian assets on the whole has been underperforming the market. Indian debt issued by corporates and banks have underperformed the Asian peers. For us to change our cautious stance, we are looking for the Indian government to put in place reform policies that would keep a lid on inflation and promote stable growth.